Have you ever noticed that when something starts to trend, you start seeing lots of videos on YouTube about it? How about the Chinese car company NIO? Just take a look at all these videos on YouTube. Let me show you one way to generate an income by selling covered call. Welcome stock hackers, I'm Jim Ray and this is Simple Option Trading, where I share my profitable stock investing and options trading strategies so that you can learn and earn more. Lately, I've been seeing more and more information about NIO, the Chinese-based automaker. And with this uptake in interest not only in the news and social media, I want to see if I can take advantage of it to generate an income using some stock options. The latest news shows that NIO is also planning to launch a smartphone beginning in September of 2023. Based off of that news, I think this stock could see a jump in price in the coming months ahead. Now is a good time for me to explain how selling covered call options works and how you can generate an income. If you're already familiar with this, that's fine. Just go ahead and skip ahead almost 3 minutes, and I'll see you after my explanation. So let's walk through this scenario where you're selling a covered call. You can see yourself there on the left, and the stock market with buyers on the right. Now let's say you own 100 shares of a company called ABC, and you paid $50 per share, so that's a $5,000 investment. You could use those shares to sell a covered call option contract. And you can set the strike price at $63, which is higher than the price you paid, and an expiration date that's roughly 1 month out. So let's go with September 27th of 2023. So with that covered call option contract, you can make it available to the stock market. Now an interested buyer will say that they want to buy that covered call option contract from you. And to purchase that contract from you, they're going to give you something called the premium payment. So in exchange for the premium payment, that buyer will actually receive the covered call option contract. Now let's find out what happens with that option contract 1 month from now. So there's two possible outcomes. The first outcome is where the buyer actually exercises the option and purchases the shares. So in this scenario, on the expiration date, September 27th of 2023, the actual market price is higher than the strike price. So in this example, the strike price is $63. But let's say the current market price is $65. So the buyer is motivated to exercise the option contract because they can buy 100 shares at $63 per share, even though the current market price is $65 per share. And so the buyer exercises that option contract. They pay you the $63 per share, and in return, your shares get assigned over to the buyer. So the buyer now owns the 100 shares of ABC stock, and you receive $63 per share for your 100 shares. So you make a profit from selling those shares. Remember, you purchased them at $50 per share, so you have a price appreciation of $1,300. Plus, you also get to keep the premium payment that you received in the very beginning when you sold the option contract. Now let's take a look at the second outcome, and this is where the option contract expires. This occurs on the expiration date when the market price falls below the strike price. So in our example, if the market price were $60 and the strike price is $63, the buyer is not motivated to exercise that option contract because they can just go to the regular market and purchase shares for $60. So in this case, the option contract expires worthless and is no longer valid. And the end result? Well, you get to keep the shares of ABC stock that you hold, and you also get to keep the premium payment that you received initially when you sold the covered call option contract. One of my secrets for profitable trading and investing for wealth is my one-button stock screener. It's literally the first tool I use whenever I sit down for a trading session. It helps me narrow down the list of over 8,000 available stocks and find good candidate stocks and ETFs that'll help set me up for profitable option trades and long-term investing wealth. This PDF file contains hyperlinks that are pre-programmed with targeted criteria that automatically activate a free stock screener in your web browser. You just push a button on the link and you'll get a list of stocks that you're looking for. Find stocks that are trending higher. Or maybe you want to see stocks that are recommended by professional industry analysts. Or even stocks that pay you larger premiums. Now who doesn't want that? So join my newsletter and get access to download my free one-button stock screener. Head on over to stockhacker.com. But wait, there's more. I've got a new revision coming out of my one-button stock screener. So be sure to sign up for my free newsletter and you'll get access to my one-button stock screener today, and you'll also be notified when the new and more powerful update is released. So be sure to sign up at stockhacker.com. So now let's take a look at NIO stock by jumping over to my brokerage account where we can actually look at this current stock price and also check out the option chain. So here we are on my brokerage account, and we can see the current stock price for NIO, stock symbol NIO. It's $10.65. Let's take a look at the option chain. I'm going to do that by clicking where it says Trade NIO Options. And I'm interested in selling a covered call. And I'm going to use an expiration date of September 1st, which is 2 days out. So that's a pretty short contract period. But we can see the current stock price, $10.65. So looking at the option chain, we can see that if I use an $11 strike price, it's currently paying 11 cents per share as a premium payment. But what happens if I go a little bit further out? Let's take a look. I change the expiration date to September 8th, which is 9 days out. And we can see that the same $11 strike price is paying 29 cents per share as the premium payment. I went ahead and opened up my covered call analysis worksheet so we can take a look at, if we were to use these shares of NIO stock, what's the potential profitability of using them shares to sell a covered call. So here we can see the stock symbol NIO, and we saw that the current market price was $10.65. Now, I'd be interested in selling one covered call option contract, so that's 100 shares, and so the value of those shares would be $1,065. Now, we use the expiration date of September 1st, which would make the length of that option contract only 2 days. So that's a really short option contract period. But we saw that with a strike price of $11, it was currently paying 11 cents per share as the premium payment. Now keep in mind, my cost basis was $10.65, and so my total cost to purchase those shares would be $1,065. Now, if the option contract were to get exercised, I would realize a price appreciation of $35, and that equates to a profit of 3.29%. Now, when I initially sold the covered call option contract, I received a premium payment of 11 cents per share for those 100, and for those 100 shares, that equates to a premium payment of $11, and that represents just over 1% as a profit, and that represents just over 1% as a return. Now, if the option contract gets exercised, I would see a maximum total profit of $46, which would be just over 4.3% return on my initial investment. We also took a look at using a different strike for the same stock. So again, the strike price was $10.65, but in the new case, the expiration date was September the 8th, giving the option contract a length of 9 days. But as we notice, the same strike price of $11 was currently paying 29 cents per share as the premium payment. Now, if the option gets exercised, I'd still realize the same price appreciation profit of $35 or 3.29%. However, that premium payment would now be $29 in my pocket, and that would be a return of 2.72%, which would make the maximum total profit if the option gets exercised. I would realize a profit of $64, which would be a return of just over 6%. Remember how I started this video when I talked about the Chinese automaker NIO and how it seems to show up in a lot of news and YouTube videos? Well, we can use that same type of approach, or the trending news information, to also look for other stock trading opportunities. I'm over here on Yahoo Finance, and we can see there's a number of different things that show up. The first thing that jumps out to me is Nvidia. I see a number of different articles, right? Here's one. Nvidia is the AI king, but threats to its reign abound. And also, Nvidia just hit record highs, but may still be cheap. So on that note, let's take a little bit deeper look at Nvidia. Stock symbol NVDA. And you would do this research for any of the stocks or ETFs that you're interested in trading in. You just want to check some of the numbers, make sure the company looks good, right? So Nvidia's got a market cap of $1.2 trillion, and we see an average volume of just over 51 million shares. So there's lots of liquidity here, which means that if I'm actually at a point where I'm holding this stock, I know that I'll be able to sell it because I know there's a market out there of buyers, right? So there's this represents a number of buyers and sellers trading this stock, and 51 million shares being traded, that's a lot. We can see that it's got this company pays a dividend of 0.03%, so not that much. It works out to about 16 cents is what it has been in the past. So it does pay a dividend, but really you're not getting this stock because you're looking for that dividend payment. I mean, you do want it, but you're mostly anticipating there's going to be price appreciation. Now, the industry analysts, they give this stock an estimated one-year price target of $619.18. So it's got plenty of upside potential there. Now, if I scroll down, we can actually see what the industry analysts think of this stock. And we can see that in August, there were a total of 38 industry analysts. 7 gave it a strong buy, 14 a buy, 15 analysts gave it a hold, and then looks like maybe 1 gave it an underperform and 1 analyst gave it a sell rating. But overall, this stock had an overall recommendation rating of 1.8, and you can see it here on the scale where 1 is a strong buy and 2 is a buy. Now, the other thing you want to look at is some of the financials of a company. So if you just scroll back up, you can see the embedded menu tab here. You can look at financials. You click there, and you're automatically brought to the income statement. And you got other tabs to the balance sheet and the cash flow. So I always like to do a quick look just to make sure that financially this company is doing well. Now, if you want some help in figuring out what to look at, be sure you take a look at my 1-minute financial review. It's a free download. It's a free cheat sheet that you can download from my website. So I like to look at the total revenue and see that it's increasing over time, and so these numbers look pretty good. The balance sheet, again, assets. You always want to look at the assets, the debt, other numbers here, and everything here looks pretty good. And then finally, the cash flow statement. We can see that this company has operating cash flow. It actually dipped down from 2022, and it's likewise, you can see that reflected as well as from the free cash flow, and that's because this company's buying back shares of stock. They're investing in new infrastructure so they can ramp up their production of their chips to meet the demand. Another thing I like to look at when I'm considering a stock for an option trade is always looking at the chart, right? So I like to do my technicals. And here we see a daily chart for Nvidia going back 1 year to September of 2022. And we can see that this stock has been on an upward climb, right? In fact, it gapped up here, looks like on May 25th. The earnings at that time on the 24th of May, the day before, you can see that Nvidia stock beat earnings by 18.02%, and the revenue was up 10%. And then most recently, the most recent earnings occurred on August 23rd, just last week, where they beat earnings by 29.69%, almost 30%. They beat the industry analyst estimates, and the revenue was up just over 20%, almost 21%. At 20.75. So this stock has been rapidly moving higher. It looks to be, if I draw a trend line here, let me go ahead and do that, where we can see, if I go to there and draw my trend line like that. So something like that, you can see we're seeing higher lows. So we can see that this stock has been trending higher over time. And if we want to compare how it's doing to the S&P 500, well, I go ahead and do that. And now we can see where for the past year, the S&P 500 is up almost 15% for the year, 14.98. But Nvidia is up 249% over the past year. So this stock is rapidly growing very quickly. Doesn't seem to be any stop in sight, especially with the interest in artificial intelligence. So you've heard about AI, ML type applications, and more specifically things like Google's Bard. You've heard about OpenAI's ChatGPT. So there's plenty of stocks or plenty of companies out there that are producing AI or AI-based services, and the majority of them utilize the chips that are produced by Nvidia. Here we can see Nvidia stock symbol NVDA. It's trading at $493.61 per share. Let's check out the option chain. So I'll select the button Trade NVDA Options, and I'm interested in selling a covered call. And again, we're going to use that September 1st expiration date, which is only 2 days out. And we can see, and as I scroll down the option chain, we can see that using a strike price of $495, it's currently paying a premium of $5.40 per share. And if I go out to the next expiration date of September 8th, which is 9 days out, we can see that the same strike price of $495 per share is paying a premium of $11 per share. Now let's jump back to my covered call analysis worksheet and plug in some of the numbers that we found for Nvidia, stock symbol NVDA. Now the market price was $493.61. I'd be interested in selling one contract. So that would be 100 shares of stock, and that cost for those 100 shares, that would be $49,361. So if you've got $50,000 sitting around in your portfolio, that's what it would take to execute this particular trade. All right, so we looked at an expiration date of September 1st, which was 2 days away, and a strike price of $495. So just under $2 higher than what the current market price is. Now, the option premium being paid when we looked at that option chain was $5.40 per share. So if the option now if on the expiration date the option contract got exercised, the buyer would purchase the shares from me at $495 per share, and I would realize a price appreciation of $139. Or about 0.28%, so not a huge profit gain there. But the premium that I received, that $5.40 per share, for that 100 shares, that premium payment equals $540, and that represents just over 1% return on my cash investment. So at the end of the day, if on the expiration date my option were to get exercised, I would see a total maximum profit of $679, which represents a return of 1.38% for this 2-day option trade. That's not bad. That's an annualized return rate of 174%. Now, if you remember, we also took a look at an option contract where the expiration date was September the 8th. So all the variables are the same market price, same contract, and the same cost for those shares. However, now the expiration date you can see is September 8th, which would make the length of this option contract 9 days. Now we still have the same strike price, $495, but this time the option premium being paid, it's $11 per share. Now the profit from price appreciation is exactly the same, and that's because we still have the same cost basis and the same strike price. And so that's only $139. But now if we take a look at the premium I received, it's $1,100, and that's because it's $11 per share times the 100 shares. And that $1,100, that represents a return of 2.23% based on my initial cash investment of just under $50,000. So now on the expiration date, if the option gets exercised and I get paid for my shares, that profit, including the money I received from the premium payment, would give me a total profit of $1,239, giving me a total profit of 2.54% for this 9-day option trade. And that works out to an annualized rate of just over 70%. Not too bad. Now, using that same news and social media approach, we can see that right here at the very beginning of Yahoo Finance, their big headline is Salesforce beats on revenue and outlook and the stock pops. Let's take a look at using Salesforce, symbol CRM, as a possible option trade. Now back over on my brokerage account, we can see Salesforce, stock symbol CRM, which is trading at $227.03 per share. Let's check out the option chain to find out what kind of option premiums I can get paid. So I'll press Trade CRM Options, and I'm interested in selling a covered call. We'll use the September 1st expiration date, which is just 2 days out. And by looking at the option chain, we can see that for a strike price of $227.50, I can receive a premium payment of $1.80 per share. Now pushing the expiration date out to September 8th, that same strike price of $227.50 is currently paying $2.49 per share as the premium payment. Now for this last example using Salesforce, stock symbol CRM, we saw that the current market price is $227.03 per share. I'd be interested in selling one option contract, and so the cost for me to purchase 100 shares right off the bat at the market price would be $22,703. Now we looked at selling a covered call option contract with an expiration date of September 1st. So again, this is a 2-day option contract. And we picked an option strike price of $227.50, which we saw is currently paying $1.80 per share as the premium payment. The buyer would purchase my shares at $227.50 per share, giving me a price appreciation profit of $47, or just about 0.21%. Now for selling the option contract, I would receive $180 in cash, which is a 0.79% return on my investment. And on the expiration date, if my option gets exercised, I would receive a total profit of $227, which is a 1% return on my investment. Now let's take a look at what happens if I use Salesforce, symbol CRM, to sell an option contract, but it expires a little bit later. So it's the same price, right? $227.03 to purchase the shares. But this time I'm using an expiration that's a little bit further out. It's September 8th, which would make the length of this option contract 9 days. Now if the option contract gets exercised, because we're using the same strike price of $227.50, my price appreciation is exactly the same as the earlier example, so I would receive $47 in price appreciation, or 0.21%. But now, the premium payment I would receive is $249. And that represents a 1.1% return based upon my initial investment. Now, if the option contract gets exercised, the total profit I would receive from price appreciation plus the premium payment would be $296. And that represents a 1.3% return off my initial cash investment. So in this video, I shared with you a few things. Number one, I shared with you how selling covered calls can help you generate an income for yourself. Number two, I showed you one way to take advantage of social media and trending news about companies and their stocks, and utilizing that information to possibly make a profitable option trade. And the third thing I showed you is you can get a free copy of my one-button stock screener by joining my newsletter at stockhacker.com.